you for tuning into this update. I'm Joshua Dobi. Appreciate so much you taking a little bit of time here as we've now crossed, ready or not, the halfway point in the year, the end of the second quarter. Very interesting things happening in the markets, and because I want to be respectful of your time, I'm going to go ahead and dive right in and give you some of our thoughts to them. Second quarter, boy, a lot of the continuation from what we had in the first quarter. First quarter came out red hot. You heard me say that in my last update, that very surprised in terms of how quickly, positively, the markets as measured by our most popular indices really came out of the gate here in the first quarter. We had a lot of the same in the second quarter. S&P 500 index, one of the most widely used indexes, not necessarily better or worse than other indexes, just quoted a lot. So I'm going to use it here. 10% in the first quarter, another 5% in the second quarter. So 15% overall return in the first half of the year for the S&P 500 index. You may say, wow, the overall market must be doing really well. Well, not really. Actually, with the S&P 500 index, you heard me talk about this a lot previously, we have an index that is market capitalization weighted. What that means is bigger companies, bigger influence. The largest companies in the S&P 500 index right now, almost exclusively, large technology companies. So companies like NVIDIA, Meta, Alphabet, the old Google, Apple, those are the ones that are going to be moving the index the most. And they have almost across the board, not all of them, but almost across the board been very, very positive for this year. So what that means in my end of the universe, sharing that with you, yes, the S&P 500 index is comprised of 500 companies. However, in my world, it's also being unnaturally skewed by these largest companies who all happen to be in the same sector by and large. And that's covering for a lot of other companies, a lot of other sectors, which aren't having as positive years right now. Now, that's not to say that the overall market has been unnaturally negative. As a matter of fact, among the most popular sectors, it's really only real estate that has had a negative first half of the year. Financials are up, oil and energy are up for this year, not at the same level of technology, but relatively speaking, still in a positive space. But not nearly as much so as technology, and that's why I'm saying the market, yes, has done well, and in many cases has had good movement in terms of positive movement in the first half of the year, but not necessarily across the board, every sector, every company. So I just wanted to give you that brief explanation there as folks are looking at the most popular indices and saying, wow, the markets must be doing really, really well. That is true in part of the market, but not true in all of the market. Actually, a good comparison point, if we're talking indexes for a moment, take a look at the Dow Jones Industrial Average in the first half of the year. I'll save you the time. It's positive about 5% this year. S&P 500 index about 15%. So far through the second quarter, the Dow Jones Industrial Average, 5%. Different constituency. Inside of the Dow Jones Industrial Average, 30 companies, and they are price weighted, meaning the more expensive a share of stock, the more influence that it has over the index, the Dow Jones Industrial Index. So when we're seeing that, different companies that are not necessarily in the technology sector definitely having an influence over that. And again, positive, just not nearly as robust. And then if I bring the NASDAQ composite, which is almost exclusively technology companies, very big year to date as of the end of the second quarter at 18%. So again, some very interesting dynamics there. Now, one of the big things that we're getting a lot of questions from you regarding, and understandably so, is what's going to happen with regards to the elections coming up here in the first week of November. I'm going to give you a terrible answer to start. Nobody knows, right? But what we can reasonably assume in this kind of season, it's going to be very noisy, and there is the possibility for volatility. Now, we're watching closely not just what happens in the Oval Office, but also what happens in Congress, because from a legislative standpoint, that's much more meaningful in terms of the kinds of impacts we may see with regards to the monetary and fiscal policy after the election. We're watching it very closely. The balances in the House and the Senate are very, very close in terms of the balance between Republicans and Democrats. So any shift of any kind is going to have some measurable impact in terms of future policy coming out of Capitol Hill. So we're going to be watching that very closely. As we get closer, and certainly as we get beyond it, you're going to hear from me in additional ways about the kinds of things that we're seeing. One of the big ones, just as a sidebar very quickly, one of the big ones that's sitting out there are the number of tax and estate laws, which are scheduled to sunset at the end of calendar year 2025, or at the end of next year. That's a very big deal in my end of the world. For a lot of you as well, that's a very big deal. We're watching that very closely because this next Congress is going to be sitting as those laws get ready to sunset. So what's going to be allowed to sunset? What's going to be extended? What's going to be modified? Is there going to be negotiation? Most likely on what the adjustments are going to be. Very big impacts from a tax and a state standpoint. We're going to be watching that. Certainly we'll bring more to you as we have greater clarity with what's happening on Capitol Hill. All right, then with regards to the Federal Reserve, big deal. A lot of speculation. Actually, as at the time of this recording, Fed Chair Jerome Powell was on Capitol Hill giving his testimony to the House Financial Services Committee, giving some indication about what his thoughts are and about what the Board of Governors' thoughts may be for the balance of this year. It appears, and you can obviously see from the tone of my voice and my body language that I'm not particularly in favor of this, but it appears that they're setting themselves up to announce a rate cut. Now, when we say rate cuts, that doesn't mean that they're going to be going back to where they were. Don't see that at all. But it is possible that we may have a 1/4 point rate cut here over the next several months. Now, as I just indicated with regards to the tone of my voice and my body language, I don't personally, in my professional opinion, think this is a good time to be cutting rates. Not that I don't want folks to have cheaper mortgages or cheaper car loans, those kinds of things, but there's another side of that as well. As many of you know now, yes, it's more expensive to have a mortgage, but my goodness, now we have some money market and CD possibilities, which are finally paying some more reasonable interest rates. Those two things go together when we're talking about a rise in rates. And so when we're looking at the overall space, especially just coming out of a very significant inflationary environment that we've just tempered, in my opinion, and this is the subjective part of things, we're a little bit early to be talking about rate cuts. So it's going to be interesting to see what the Federal Reserve does. Obviously, we're watching it very, very closely. And also, not to be too much of a hypocrite, the equity markets, the stock markets, really want a rate cut or more than one rate cut because the cost of capital decreases, makes liquidity much more prevalent and easily moved throughout, especially our equity market systems. And so there's a lot of desire by the stock market for an interest rate cut, 2, 3, 4, or more. So we're going to be watching that very closely to see what happens. Certainly the ramifications, if that happens, we'll bring that to you with our thoughts. And certainly if there's a divergent move in something that's not anticipated, you'll certainly hear from us as well. So, all right, we got the election, we got the Federal Reserve, we got second quarter performances. What are we looking at in terms of market performance for the balance of the year? Well, because the equity indexes at this point are so positive, you know me, I'm more conservative in terms of how I look at things. If we would flatline for the rest of the year, this would still be an above average positive kind of year from a performance standpoint. Truly, when you look almost across the board, this would be an above average performance year, even if we flatline. So our expectations for the second half of the year are quite reserved. To put it differently, it wouldn't be surprising at all for us to have what's called a technical pullback, meaning that because we've gone above the average for so long, we are due, from a technical standpoint, to have some level of pullback, meaning to get below the average for a little bit in order to get the average. So we're watching that very closely to see what the indications may be for a technical pullback in the near term. A fundamental pullback where it has to do more with economics and companies, meaning in terms of are they doing well, are their profits increasing, are they continuing to grow, to expand, to reward shareholders, etc. We're not seeing as much fundamental concern at this point. We're coming into earnings season again here very shortly, actually at the end of this week, as of the time of this broadcast. We're going to be getting some of our big financial institutions starting to go through their quarterly earnings. We're watching that very closely. That tends to be an indication of consumer sentiment, especially when it comes to our large money center banks, about whether folks feel more advantageous in taking out loans or whether they're more reserved because of the higher cost of capital. You remember GDP, gross domestic product in this country, is between 2/3 and 3/4 a function of consumer spending. Basically, as the consumer spends, so do we go as an economy. So if the consumer is starting to slow down, to pull back a little bit, that will absolutely affect our GDP and our overall economic growth. So we're looking at that, not to look at just one variable. That's a pretty good sized variable in the algorithm of understanding where we are economically right now and what we can anticipate for the balance of the year. So again, our expectations are much more modest in terms of returns. And to be fair, 2 quarters ago, I told you to have pretty conservative expectations for this year, and boy, we're way ahead of expectation in the first half. So we're going to be watching closely to see if there's going to be any kind of moderation, perhaps a technical pullback, and then there's always geopolitical risk. That's always true. There are always going to be factors out there that we can't quantify that can happen unexpectedly, which definitely can dampen the markets in the short run. So I want you to hear from me as we're looking at the balance of the year. Keep your expectations appropriate. That's so important. Let me put it another way. Be very cautious if you're just chasing where the high performance has been to date. Because remember, those performance figures are looking back. We're much more concerned. We're thankful for what has gone before when it's positive, but we're much more concerned about what yet lies ahead. So make sure when you're making tweaks, when you're making adjustments, you're not doing so just chasing what has done well, but rather with an understanding in the best ways that we can, understanding there's always a lot that we don't know, but in the best ways that we can about where we anticipate the markets are going to be. And that's very, very important when you're looking at portfolio management, very, very important for your financial plan. If you'd like to reach out to us, always, you know that. Feel free to contact us. I love chatting with you on the phone, in person, on a Zoom video call in this day and age, even if it's just a chat about all the noise in the system, political and otherwise. And maybe more importantly, if you want to let me know where you may be traveling over the summer, especially if you have little ones, grandkids, all that good kind of stuff, I think that makes life worth living, and I enjoy hearing from you about all of those kinds of things. We're in the throes of baseball season. If you follow baseball like I do, if you're one who follows our Pittsburgh Pirates, we need to get some pitching and some hitting in order. I want to see if we're going to get a bat before the end of the trading deadline. Fingers crossed that we do for all of our Pirate fans out there. Well, friends, again, like I mentioned, anytime that you want to reach out to us, give us a call, drop us an email. Love to chat with you. Looking forward to chatting with you again soon. And until that time, bye for now.